Second point I want to look at today is the other end of the scale. So we said 7 things for expats to look on tax changes this year. We're not just talking about income tax. Here is capital gains tax, and this is an impact for UK property investors. So in the UK, when you sell your own or main resident, then it's capital gains tax free. Now, that's absolutely fine if you're living in the UK, but if you're an expat, by definition, things start getting complicated. You could keep the property empty and try to claim it as your main residence. There's complications on that. We'll come back to that later. But that's obviously subject to approval and being caught up in the changes that come into force from the 6th of April 2020. So you need a clear vision of what's going to be happening going ahead. There's a capital gains tax on residential property of 28% in the UK. 28% is the rate in the UK. There is an allowance of about 12,000 a year, but if you've got a capital gain, then that's about 28%. Now, all properties in the UK were revalued in 2015. So if you bought a property in 2015 and you're selling it for £100,000 profit, no allowances, 28% tax is your liability. 28,000 on every 100,000 you make on property sales. And for people in highly proper, sought after areas, in the centre of the big cities, the prosperous cities like London, Manchester, these sums could be quite high. There was in the past, expats could try and avoid that. So UK expats that are abroad and are not in the UK at the time of realising those capital gains generally can get an exemption from that as long as they don't return to the UK within 5 years. That can work for business, it can work for shares, it can work for lots of different capital assets, but not for residential property. Now, again, it's not if it's your main residence, but if it's been used as a rental property or it's a commercial building, then these capital gains taxes are going to apply. And if it's a residential property, it's 28%. It's slightly lower if it's commercial. The catch in the change of the legal requirements from the 6th of April 2020 is that there's a capital gains tax assessment at the point of sale. So while you're selling your property, buyers are used to paying stamp duty. Sellers are now got to get used to paying the capital gains tax out of the sales process. They cannot complete the sale until they pay the capital gains tax. And the conveyancers that are regulated under common reporting standards, if in doubt, they have to pay the tax, just like stamp duty, and you have to reclaim it later. So an expat could have a legitimate claim not to want to pay that capital gains tax. There could be mitigating reasons, but if the sale is to go through, the conveyancer has to pay the capital gains tax first to allow the conveyance to complete, and then a tax return needs to go in to claim that money back if there's a legitimate reason to reclaim that relief. So in the past, you could sell a property on the 6th of April, do the tax return on the following 30th of January and pay the tax a year later. So you could get up to 21 months deferred payments for that capital gains tax. Now it's when you sell the property. So it's a big move and that's come to a fruition now, and anybody that's in that position has got that liability going forward. Wouldn't necessarily count for family gifts. So if you're making a family gift to a family trust, then there's a way to avoid paying that capital gains tax. And it doesn't apply to any any business assets, any company assets that you may have, any shares or any other asset that is not real estate in the UK. So there's a big new tax for expats to pay, or anybody selling a property from the 6th of April next year. need to look at the consequence of that and be mindful of that in their buying and selling process, and look at what tax returns need to be done. If you want any guidance on that and help with that, and that tax return, contact us at proactpartnership.com.